Trump is about to unleash another 1929 stock market crash. Trump's tariffs are a sure way to repeat the conditions of the 1929 stock market crash. We're entering storm season in the Caribbean and the southeastern United States. But that's not the only storm making its way to the East Coast. A financial storm is brewing, potentially leading to what could be a repeat of the 1929 stock market crash. Even though the Dow Jones Index continues to hover around its record high, cracks are starting to show. The issue Americans are ignoring is trade. More specifically, the issue is trade tariffs. The problem may have something to do with the fact that schools don't teach the Great Depression very well. They focus more on the Depression and less on the causes of the stock market crash that triggered that long phase of economic turmoil. While reviewing 10 of those causes in a previous article, one struck me in particular. The 1929 stock market crash occurred after a phase of irrational exuberance. The years and months that preceded it represented one of the longest bull markets in history. Coincidentally, the only continuously bullish phase that is longer happens to be the present bull market that started in 2009. In fact, it holds the record as the longest bull market ever. If the endurance of investors' faith is one coincidence, there's a second that should have already rung the alarm bells by now. The second eerie coincidence between stock valuations in September 1929 and September 2018 is that, as both were at peak bullish levels, investors seemed oblivious to trade tariffs. And the tariffs are hanging over investors' heads like the sword of Damocles. The Smoot-Hawley Tariff Act and the Great Depression indeed, as President Donald Trump has already fired the first shots of a global trade war, the markets have forgotten that the last such conflict occurred in the 1930s. More than the October 1929 stock market crash, it was the unleashing of the Smoot-Hawley Tariff Act in 1930 that turned that financial disaster, which affected investors, into an economic one, which affected everyone. Trump has launched his tariffs before a stock market crash. But the logic behind them is remarkably like the Smoot-Hawley tariffs. At the time, the strongest trade duties adopted by the U.S. since 1828, which President Herbert Hoover signed into law on June 17, 1930. President George W. Bush tried to use tariffs to prop up American steel manufacturers in 2002. But he had to abandon the idea. The European Union, still reveling in the honeymoon of the euro, acted in unity and launched a series of countermeasures against American goods, which raised the price of some items by ridiculous amounts. Source: Why Steel Tariffs Failed When Bush Was President, Politico, March 8, 2018. Thus, Bush had to let go of the steel tariffs plan by the end of 2003. Nevertheless, the trade war of 1930 was not resolved so easily. It was severe and, like the present one, which Trump is promoting, it too had a protagonist, Republican Senator Reed Smoot, President of the Senate Finance Committee. It would be fair to describe him, in trade terms at least, as the Trump of his day. The best intentions don't always produce the best results. Not incorrectly, Smoot wanted to protect American jobs, and all the more so in the wake of the 1929 crash. But he was mistaken in assuming that employment shortages were the fault of foreign countries wanting to export products to the United States, damaging the interests of American workers. If that sounds like Trump, the fact that Smoot blamed the 1929 stock market crash on a trade deficit, more imports than exports, should ring all kinds of alarm bells. Like Trump, Smoot thought that all the American economy needed to stimulate domestic employment was a good dose of protectionism and tariffs on as many products as possible. As many as 20,000 items were slapped with duties in 1930. Like Trump, Smoot managed to persuade a good majority of Congress members and voters that the tariffs would be the one solution fix-all band-aid, which would restore America's financial and economic health in the wake of the 1929 stock market crash. Also, as with Trump or better, the debate that has emerged over Trump's protectionism, many economists appealed to President Hoover, urging him not to sign the Smoot-Hawley Act. Source: The Battle of Smoot-Hawley, The Economist, December 18, 2008. Trade is a two-way street with two-way consequences. Trade regulations have global effects. Not surprisingly, then, they produce global reactions. As tariffs rose overnight in June 1930, in some cases by 4 times, the world did not hesitate. Even before such things as the European Union and a mighty industrial China holding billions worth of U.S. treasuries, a global trade war erupted. The world, and wouldn't you know it, the main members involved were Canada, the British Empire, France, Germany, Japan, and Italy hit back with tariffs of their own. The United States cut imports by some 65% in that early experiment with America First. But, exports suffered by an almost equal amount. And did Smoot-Hawley achieve its stated goal of boosting unemployment? That would be a flat no. The Great Depression may not have started with trade barriers. Yet trade barriers ensured that just about all American workers would suffer, putting the Great Depression. Tariffs can have surprising geopolitical effects. In August 1930, Italy, one of the countries most affected by American tariffs, signed a trade agreement with the Soviet Union, following it up with a non-aggression treaty. While history does not repeat itself, it rhymes. And Trump would do well to study the 1930s before raising the U.S. tariff game. There's nothing wrong with renegotiating trade rules and imbalances within the appropriate international institutions and frameworks. The goal is to cause the least amount of retaliation. If American companies have little to lose now, it's because they export fewer manufactured products than they did almost a century ago. The Europeans, for instance, can enforce much tougher fiscal regimes for such U.S. giants of the stock market as Amazon.com, Incorporated, Nasdaq AMZN, Apple Incorporated, Nasdaq AAPL, Microsoft Corporation, Nasdaq MSFT, and their FANG counterparts. Indeed, it's Europe that Trump has in his sights. The Chinese are rebuilding and reorienting the borders of trade, opening new areas and relaunching long-lost ones such as the Silk Road. Challenging Europe will backfire, loudly, but Europe is America's key ally. And by challenging Europe's very economic model focused on exports, Trump may have helped the EU find a new key for cooperation and unity. That unity also means Europe will follow more independent geopolitical policies. With tariffs in place, Europe will have less to lose by breaching Washington's sanctions against Iran. Certainly, Washington's tariffs have also encouraged more cooperation between the European Union and Russia. In other words, in 2018 as in 1930, a trade war could prove to serve as an economic and geopolitical boomerang. Senator Smoot, the architect of the 1930s tariffs, remained convinced until the end of his days that the reason his policy had failed was because tariffs had not been raised enough. President Trump, unless he plans to use the trade tariffs as a platform from where to establish a position of strength ahead of talks, may be heading toward the same stubborn conclusion. Either way, it may be time for investors to focus on stocks that depend more on domestic than foreign consumption. As stated on numerous occasions at Lombardi Letter, defense stocks are the only ones that offer a trade tariff-proof valuation. The U.S. Department of Defense is the biggest buyer of U.S. aerospace and defense equipment. Thus, companies like General Dynamics Corporation, NYCGD, or Lockheed Martin Corporation, NYCLMT, will have to endure far fewer shocks than, say, General Motors Company, NYCGM, or the aforementioned FANG and tech stocks. The growth hype cannot hide the possibility of another financial crisis. Don't believe the growth hype. Debt has raised the risk of a major financial crisis. The Dow Jones Index continues to hold at record levels, hovering close to 26,000 points. But how long can the bull market continue? It's time for investors to start pondering that question, that is, before the start of a long overdue financial crisis. The U.S. Federal Reserve's hints about slowing down the pace of interest rate increases have not helped. Rather, rumors to this effect have put a tailwind on a stock market that was beginning to show signs of healthy self-doubt. The Fed's monetary easing and low interest rates worked their magic in helping stocks recover after the 2008 financial crisis. Yet the Fed's policy of raising rates at regular intervals, starting at the end of 2015, has not helped cool down the speculation instinct. That's not as optimistic a scenario as it sounds. The Fed did not announce plans to reverse the hikes, merely to slow them. And rising interest rates, regardless of their extent, have always produced a drop in stock market valuations. As it happens, price-to-earnings, P/E, ratios, a key if somehow forgotten metric in the case of certain stocks I'm looking at Tesla Inc., Nasdaq TSLA, have started to fall compared to the resumption of rate hikes. Source: stocks are in the danger zone, and it is assured that a bear market will occur in the next year, analyst warns, MarketWatch, September 10, 2018. The performance of the current market has defied the odds. Key interest rates have risen while investors have not so much as expressed the slightest hesitation. The stock markets, in that sense, have defied history. Investors should be more afraid than enthused because the current trend suggests that everyone is still behaving as if in a state of stupor. The hangover in due time will be even more dramatic and painful. It will be hard to stop the resulting crash from evolving into a full-on financial crisis. In addition, U.S. Treasury yields have also been increasing. The 10-year Treasury note has reached a level just shy of 3%. Nobody knows what the psychological threshold might be now before investors take notice and pull away from stocks. The difficulties of countries in emerging markets like Argentina and Turkey, which could suffer more blows as the Syrian government moves in for a final offensive to retake control, have pushed the dollar higher. In a situation of higher tariffs, or the threat thereof, the dollar would serve Americans better if it were low. The dollar has moved too high for the good of the global economy. Despite President Donald Trump's efforts, the U.S. economy does not operate in isolation. Its health also relies on the good health of others. Instead, the higher U.S. dollar presents significant risks in the wake of higher trade tariffs. Source: 3 ways the strong dollar is impacting your investment portfolio in 2018, Forbes, August 13, 2018. Trump wants low rates rather than steady increases. Could Trump's attitude to interest rates explain why the markets are continuing to hover around the Dow's January 2018 record? President Trump has made no secret of the fact that he doesn't like the high dollar. After all, he appointed Jerome Powell to the role of Federal Reserve Chair to continue with his apparent dovish attitude to rates. The recent set of macroeconomic data, i.e. job numbers, showed that job growth, however precarious those jobs may be, continues. Even salaries have started to go up. Source: U.S. wage gains pick up to 2.9% while payrolls rise 201,000, Bloomberg, September 7, 2018. Nevertheless, the wage and employment story represents a clear case of the old saying, all that glitters is not gold. Wages should have been rising at a much faster pace, given the tighter U.S. job market. And that reveals a well-known secret about the current economic recovery: it's nothing to write home about. The tax cuts have distorted the entire economic picture. Tax cut-driven growth has put enormous strain on the already dangerous debt situation in the United States. After all, how did you suppose the tax cuts were being financed? Yes, it just goes on the debt bill. But that's what makes the growth so hollow. The real economy can't sustain it, and the out-of-thin-air financial economy has become one tax cut-fueled bubble, whose continued ability to tolerate a bull market defies logic. Still, the Federal Reserve cares little about where the growth comes from. Its main goal, a veritable obsession, remains to control inflation. Despite the rumors that the Fed was planning to slow down the interest rate hikes, the job and wage figures compel it to continue along the rate hike path. And that's when the proverbial fun begins. The interest rates will put U.S. household debt in jeopardy. Everything from credit cards, to mortgages, car loans, and student loans will be harder to pay off. The rates will remove that veneer of the middle-class lifestyle, however usurious in origin, from most American families. Years of ultra-expansive monetary policy, with nominal rates near zero, have made families accustomed to resort to debt in lieu of stagnant, if not declining, compared to inflation, wages and high unemployment. Debt keeps the world turning. Moreover, businesses and governments have also used debt to keep the economy moving. No government, least of all that of the United States with its $21.0 trillion plus national debt, has learned to give up this instrument. Now that interest rates are going up, Washington and many other capitals around the world, even those in Europe, starting in 2019 will face the risk of a debt blow-up as rates increase everywhere. The result of all this dependency at the global level means that the world owes some $230.0 trillion. All it takes is for one or two countries to go into default to trigger a domino effect. Given their relative weakness and the need to buy US dollars, which higher Fed rates have made more expensive, emerging markets should be a great cause of concerns for investors. The prospects of another global financial crisis are considerable. The higher value dollar has emerged as the trigger. In emerging markets, the dollar effect accelerates and compounds the effects of a financial crisis because it triggers capital flight. Those who can, buy dollars or treasuries to protect their assets and savings. Argentina and, to a lesser extent, Turkey have already experienced these situations over the past summer. But it's merely the beginning. The fact that debt and default risks are inviting a new financial crisis does not discount the potential economic damage that could result from fears of a trade war. And that's where Americans should be most careful. In a world full of tariffs, a high dollar